This is Macro Horizons, episode 372, Reenvisioning the Range, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of May 4th. And with April showers out of the way, I think we've all earned some May flowers, or at least fewer dissents. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market took its primary cues from developments in the Middle East. Trump rejected Iran's proposal to reopen the strait and save the nuclear conversation for later, and the resulting price action in the oil market followed intuitively, with front-month WTI moving toward $110 per barrel. There was also some sharp price action associated with Powell's press conference, primarily because he said that he continues to stay on the board. Now, it's probably unlikely that he stays all the way until early 2028 when his term as governor expires, but for the time being, Powell will remain in the room when Warsh takes the helm of the FOMC in June. This also means that Governor Miron's seat will need to go to Warsh, which in effect limits the administration's ability to add or keep another dovishly biased member of the FOMC. We'll argue that the bearish response in the front end of the curve was warranted because Powell staying on the committee does leave the Fed incrementally more hawkish than might otherwise have been the case. The changes to the FOMC's statement were relatively minor. However, there were three hawkish dissents. Now, these were not hawkish dissents in favor of a rate hike, but rather against some of the language, which is generally understood to signal that the next move will be a cut. Nonetheless, it is worth noting that that language ultimately was retained, and Powell did not dissent. Therefore, as a departure point, we're comfortable with the notion that the bulk of the committee still sees the next move as a rate cut. The question isn't one of direction, the question still remains one of timing. Using this as a departure point for determining when the front end of the market has cheapened up far enough that it might make sense to add exposure to the two-year sector, we'll continue to watch the futures market for any attempt to price in a material probability of a rate hike this year. Our base case remains the Fed is going to be on hold for the foreseeable future, but at one stage, normalization will return. By and large, the war in the Middle East continues to define the agenda in the Treasury market, providing the most impactful macro influence for the global economy, primarily in the form of higher energy prices. Until the final week of April, energy prices had begun to moderate somewhat, and the market had gradually moved away from effectively trading tick for tick with oil. But as oil prices once again crossed the $100 per barrel threshold, we've seen the macro conversation shift back to focused on attempting to estimate how long the Strait of Hormuz will remain closed and how long Iran can weather the U.S. naval blockade.
We have Powell's final Fed meeting as FOMC chair, but not necessarily final Fed meeting, period, as at the press conference on Wednesday, he confirmed that even after his term as chair expires in the middle part of May, that he will stay on the Board of Governors until there is a more complete resolution of the DOJ investigation of the renovations of the Federal Reserve Building. That was one piece of new information that we gleaned from Wednesday's FOMC decision, but by far the more important revelation was an FOMC statement defined not by the bias of monetary policy or the characterization of the economy, but rather four dissents, which is the first time that's happened since the early 90s, with Miron advocating for a rate cut, while Kashkari, Hammack, and Logan all were comfortable leaving rates unchanged, but dissented in favor of removing the easing bias from the formal language of the policy statement. This was rightfully interpreted as hawkish by the market, with treasuries bear flattening in response. And while it wasn't especially surprising to see who the three hawkish dissents were, it does represent a more formal pushback from a contingent of the committee who is clearly more comfortable with the idea that the path forward from rates from here might be more symmetrical than what has been assumed to be a foregone conclusion, and that the next move will be a cut. And as Warsh, who is headed to the floor for a full confirmation vote, prepares to move into Powell's office, he clearly has the first three committee members that he will want to try and persuade that another rate cut or two is probably appropriate at some point this year.
And to be fair, the dissents were very consistent with the idea that different members on the committee have different estimates for what the neutral policy rate is. And we know that some committee members, these three in particular, presumably, believe that neutral policy is closer to 375, for example, and therefore, given the cross currents of economic risks at the moment, signaling that we have reached neutral, normalization is over, and monetary policy will remain on hold for the foreseeable future with symmetry at these levels, is at least intellectually consistent with what we see via the dot plot. As progress towards Warsh taking over the FOMC as chair in June continues, we're increasingly pondering exactly what a Warsh Fed will look like. We suspect that dissents will become the norm, and at least during the first couple meetings, there will be no change to monetary policy rates. Warsh has messaged that he wants to shrink the Fed's balance sheet over time, and that will afford more flexibility to lower policy rates. While he might be able to eventually get the committee there, clearly it's not going to happen by the June meeting. Moreover, recent comments from Warsh indicate that he's going to review the level of transparency offered by the Fed. This could include a reduction in the frequency of the SEP or elimination of the SEP and forward guidance altogether. Again, such changes will take time to implement, but in light of the rhetoric of Warsh coming in to, quote, reform the Fed, it's clear that he at least has an agenda. The degree to which that can be executed and the timeline for measuring success are certainly open questions, but nonetheless, it's going to be a very interesting summer for monetary policy.
And as it pertains to trading the market, the fact that forward guidance should, in the best of times, be taken with a sizable grain of salt, if not outright ignored, is hardly a new idea among market participants. One need only look at the late 2021 dot plot that showed no rate hikes through the entirety of 2022 to see the actual realized accuracy of the central bank's ability to forecast policy rates. And so in practical terms, what less concrete guidance from the Fed will mean for trading treasuries will likely be a greater emphasis on the FOMC meetings themselves and the language within the policy statement, given that Warsh has also opined that there is simply too much Fed speak and too many opinions being offered that only serve to complicate matters and make it more challenging for the market to interpret the balance of risks around the Fed's monetary policy bias. And so, by potentially reducing formal Fed communication, maybe even getting rid of the dot plot altogether, what we expect to see when or if these changes are implemented is a greater emphasis on the economic data itself rather than various Fed presidents or governors' interpretation of that data. And so by having less frequent speeches or wider error bands around official forecasts, what we expect to see in terms of intraday trading is probably more volatility in the very front end of the curve, given an inherently more uncertain monetary policy outlook, and over the second half of this year, that should keep the shape of the yield curve especially relevant to Warsh if in fact the market swings in Fed pricing continues. Remember, it wasn't so long ago we had 2 full cuts priced in over the balance of this year. And that, combined with the quickly approaching May refunding announcement and Bessent's latest update on Treasury issuance, will likely mean, or at least hopefully mean, that this period of lower volatility and narrow trading ranges will not persist indefinitely.
And taking a step back, if we think about what the outcome of the push by monetary policymakers to increase transparency over the last 20 years has done, it has reduced the amount of perceived uncertainty regarding the forward path of monetary policy rates and therefore compressed volatility further out the curve. This same period has been associated with declining rates as a theme and has generally been bond bullish as the U.S. economy continues to mature. The question then becomes, by removing forward guidance, will the Fed effectively put a floor on nominal 10 and 30-year rates simply because we don't have the same degree of confidence that we understand the Fed's reaction function to the economic data. This is also occurring at a period in time in which term premium is well into positive territory. The market is once again beginning to worry about increases in Treasury auction sizes, and of course the implications from the war in the Middle East and the reality of oil prices now well above $100 a barrel. Taking this all in aggregate, it's not surprising to see that 10-year yields breached 440, although some buying interest did emerge, and the macro narrative, frankly, is still very contingent on developments related to the Strait of Hormuz and the U.S. naval blockade of the strait, as well as any potential response from the Iranians. In short, we expect the longer end of the curve to settle back into a holding pattern, although there certainly remains the potential for a break in either direction in light of the ever-increasing list of macro uncertainties.
And along with another meeting of unchanged monetary policy rates, we also heard from President Trump that he rejected Iran's proposal and that the U.S. blockade of the Strait of Hormuz will continue for the time being. Now, how long the time being is anyone's guess, and the next headline around a potential resolution or escalation could be right around the corner. However, more importantly from the bond market's perspective is the feedback loop between durably higher energy prices as opposed to a one-off shock that quickly retraces, and what that ultimately means for, on the one hand, inflation expectations, and on the other, the severity of the tax on consumption dynamic that we've certainly discussed as a coming growth headwind to keep an eye out for in the second quarter's data. On the inflation front, while it's a foregone conclusion that realized PCE and CPI figures are going to be heading higher, just as important, if not more important, from the Fed's perspective, is that higher realized inflation prints don't then translate to a sustainably higher inflation expectations plateau. We'll argue one of the biggest drivers of the aggressive hiking campaign in 2022 was less because of realized inflation, although that certainly was important, and more the fact that break-evens, survey-based measures, all accelerated significantly higher, and it's the risk of an entrenched wage price spiral that is ultimately a derivative of inflation expectations that really drove the Fed to tighten as aggressively as they did as the economy continued to come out of the pandemic. Now, clearly the current environment is not as severe as that environment was, and while inflation expectations have picked up along with gas prices, generally speaking, they are still well off the extremes we reached during that episode. But in the event that we continue to see a grind higher in measures like the New York Fed's inflation expectations gauge, the University of Michigan measure, and break-evens, it's at that stage that we would expect to hear some acknowledgement from even the more dovish on the committee that a longer period with rates in restrictive territory is still appropriate. In such an environment, it's also not unreasonable to assume that the more hawkish, Hammock, Logan, Kashkari, might even advocate for something like a fine-tuning hike in order to bring inflation expectations lower. And while it's probably still too soon for a conversation around that being a realistic outcome in 2026, especially if forward guidance becomes less pronounced, if we see another leg higher in oil prices, there's going to be very little to prevent the market from pricing at least a probability of that outcome.
With that backdrop, all we can say is we just hope the Fed doesn't choose to characterize inflation as transitory this time, even though it might be different.
Kevin, we hope you're listening.
In the week ahead, the Treasury market will continue to trade off of developments in the Middle East and any associated movements in oil and gas prices. The broader tone has been one of concern as energy prices continue to rise, and the ramifications will presumably be medium-term concerning for growth, but creates unquestionable upside risk for inflation in the near term. This dynamic continues to drive trading in the U.S. rates market, and we do not suspect that will change anytime soon. The consensus for Friday's payrolls print is an increase of 60,000 jobs, with the unemployment rate seen unchanged at 4.3%. Now, as the debate continues in terms of what break-even payrolls growth is needed to keep the unemployment rate changed, it is notable that there's a wide range of estimates, and we'll also be watching the labor force participation rate, which is now sharply lower than it was when we ended 2025. The market will also have the benefit of several other employment anecdotes, including the Challenger survey, Revelio, jobless claims, which have been running notably low, ADP for the month of April, as well as the JOLT series for March, all of which we expect will continue to reinforce the narrative that the labor market remains on strong enough footing to buy the Fed even more time as it endeavors to estimate the full impact from the war on the inflation complex first and then on demand as a second-order effect. Given the strength in GDP, the solid consumption figures, although they did tail off toward the end of the quarter, specifically in March, with real personal spending underwhelming estimates, it's still generally believed that the U.S. consumer has been able to weather the geopolitical uncertainties relatively unscathed. Now, do keep in mind that we just made it through tax season, and tax refunds could have come into play in some of the stronger spending figures, as could the wealth effect, given the fact that the equity market has rallied back to reach record highs yet again. Let us not forget that the week ahead also contains the May refunding announcement. No changes are expected in coupon auction sizes. Specifically, we're looking for $58 billion 3 years, $42 billion 10 years, and $25 billion long bonds. Market conversations do continue to be focused on what the war is costing and whether or not that will translate through into higher Treasury issuance at some point. And while that ultimately might be a factor in 2028 or later, the reality remains that any extra funding requirements are going to use the bill market for the foreseeable future, with the November refunding as the first potential instance in which we might see coupon auction sizes increased. But even then, the market consensus is that the longer end of the curve, 10s, 20s, and 30s, will not be increased, whereas 2s, 3s, 5s, and perhaps 7s will be the first to offer larger sizes. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with Powell's final meeting as FOMC chair now behind us, hats off for his public service, patience, and commitment to the music of the Grateful Dead. Trucking just got a lot harder with current diesel prices. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.